it's Leah Coss with the Mortgage Center. If you hear some weird noises in the background, it's my dog chewing on a bone. But I wanted to go back to basics and talk about some different lingo that I use on a casual basis in my videos, assuming that you all know what I'm talking about, but many of you don't. And so I'm trying to do some back to basics videos for you so that you can watch privately in the comfort of your own home and become educated on the different lingo that gets thrown around in the media all the time. And today's video is going to be about debt servicing. So if someone says, can you debt service it, or what's your TDS, or what's your debt service ratio, or all these things that people talk about and often they don't even know what they're talking about. But what debt servicing is basically the calculation that the banks use and that I will use to pre-approve you to see if you can afford a home or afford your current payments. Now, what is this basically calculating? Well, the TDS is a percentage, and TDS stands for Total Debt Service Ratio. If you look on my website and you search for TDS, it'll come up with a video that's actually going to show you the whole math. It's somewhat of an overwhelming video, but it'll show you right on the screen the math using specific examples of a husband and wife making X amount of dollars with X amount of payments and what their total debt service ratio is. Now, how this is determined is basically, let's say you make $100,000 a year. Of that $100,000 a year, that's a big number, not realistic for everybody, but just to make numbers easy, $100,000 a year. Based on your credit score, the bank will judge you and say, we will let you use X percentage of that $100,000 to pay for mandatory payments. So an example is typically TDS is anywhere between 40% and 46% it can sometimes go to, but mostly they're using 42% or 44%. 44% for people with good credit scores, 42% for people with okay credit scores. 40% only if, not so good credit, but good enough that the banks will accept you. If you have really bad credit, they won't debt service you at all, meaning you don't get a mortgage. So that's why credit is very important in getting a mortgage. Now, once they've determined, let's say 44% of your income can go towards paying for mandatory payments, then what they're going to do is they're going to go, well, what mandatory payments do you have? Mandatory payments, things like car payments, credit card payments, line of credit, any other mortgages that you have, those are mandatory payments. And those are payments that you basically have to pay or else. So we look at all those current payments and we minus that from what the bank will allow you to use to make payments with, and whatever's left over is how much they will let you use towards a mortgage on a new home. That's the easy way of looking at it, but again, go to that video, it'll show you all of it. Now with this calculation, it's very often that someone will come up to me and be like, geez, I make $100,000 a year, but the bank is only letting me buy a $200,000 place. What's going on? Right away I'll ask, do you have a car payment? Like a $500 or $600 car payment every month, that's cutting a huge gouge out of your debt servicing ratio. And what it's important to remember is that it's not about how much money you make that will determine how much of a home you can buy. It's how much income you have compared to the debt that you have. And that's going to dictate how much of a home you can buy. So if you have any questions about this, or if you want me to do the actual calculations and figure out your debt service ratio and how much you can afford to buy on your next home, then give me a call. That equation sounds really intimidating, but for me it only takes about 5-6 minutes to do. All I need are the numbers from you to do it with. So it's Leah Coss with the Mortgage Center. Hopefully I'll be doing your TDS debt servicing ratio very soon.